Financial management is all about planning, organizing, directing, and controlling the economic pursuits such as acquisitions and utilization of capital of the firm. Let us start with the scope of financial management. As we have already discussed in our previous lecture that financial management as an academic discipline has undergone significant changes over the years with regards to its scope and coverage. As financial management evolved from traditional phase to the modern phase, it has emerged as a distinct field of study. To know more about its scope and nature, it has been divided into two approaches. Let us start with approach 1, that is traditional approach to the finance function. It relates to the initial stages of its evolution during 1920s and 1930s, when the term corporation finance was used to describe what is known in the academic world today as the financial management. According to this approach, the scope of finance function was confined to only procurement of funds needed by a business on most suitable terms or conditions. But the utilization of funds was considered beyond the purview of finance function. It was felt that decisions regarding the application of funds are taken somewhere else in the organization. However, institutions and instruments for raising funds were considered to be a part of finance function. In this approach, traditional approach, finance was required not for regular business operations but occasional events. Occasional events like reorganization, promotion, liquidation, expansion, etc. It was considered essential to have funds for such events and regarded as one of the crucial functions of a financial manager. The traditional approach to the scope and functions of finance has now been discarded as it suffers from many serious limitations. Now let us move to second approach, that is modern approach to finance function. With technological improvements, increased competition, and the development of strong corporate, it was important for management to use the available financial resources in its best possible way. Therefore, the traditional approach became inefficient in the growing business environment. On the other side, the modern approach had a more comprehensive analytical viewpoint with a focus on the procurement of funds and its active and effective utilization. The fund arrangement is an essential feature of entire finance function. The main element of this approach are an evaluation of alternative utilization of funds. It means we should concentrate on those projects where we will get more return on our investments. Second element is capital budgeting. It is a process where a business undertakes to evaluate potential major projects or investments. For example, construction of a new plant or a big investment in an outside venture are examples of projects that would require capital budgeting before they are accepted or rejected. Third element is financial planning. It is the task of determining how a business will afford to achieve its strategic goals and objectives. Usually, a company creates a financial plan immediately after the vision and objectives have been set. Then there are other elements like ascertainment of financial standards for the business success, working capital management, determination of cost of capital, management of income, etc. All these will be discussed in details in due course of time. There are three critical decisions taken under this approach. First, investment decision. This decision is also known as capital budgeting decision. It is concerned with evaluation and selection of proposals for long-term investments. The returns from these proposals are expected in the future. A thorough evaluation of projects in terms of risk and return is made as it required huge amount of funds. Second decision is financing decision, which are concerned with the amount of finance to be raised from various long-term sources of funds like equity shares, preference shares, debentures, bank loans, etc. All it is called financing decision. In other words, it is a decision on the capital structure of the company. Major issues involved here is to determine the proportion of equity and debt in the capital structure. Third decision is dividend decision. This decision is concerned with deciding how much of the profit earned by the company should be distributed among shareholders and how much should be retained for the future contingencies, which is also known as retained earnings. The decision regarding dividend should be taken keeping in view the overall objectives of maximizing shareholders' wealth. And it should be kept in mind that dividend policy of a firm is critical to its success as it affects the market value of shares. Some authors also included liquidity decision under short-term finance decisions in this modern approach. Short-term finance functions or decisions involve a period of less than 1 year. These decisions are needed for managing the firm's day-to-day fund requirements, commonly called as liquidity decisions. Liquidity decision is related to the investment in current assets and current liabilities. Current assets includes cash, receivables, inventory, short-term securities, etc. Current liability consists of creditors, bills payable, outstanding expenses, bank overdraft, etc. Current assets should be managed efficiently for safeguarding the firms against the risk of liquidity. Lack of liquidity in extreme situations can lead to firms' insolvency. Thus, a proper trade-off must be achieved between profitability and liquidity. Thank you very much for today. We will talk about profit maximization and shareholders' wealth maximization in the next lecture. Thank you.